य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यधिकश्चन एतद्द्वैत 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 एतद्द्वैत.
Thank you everyone, and thank you to Ganesh also for accepting the invitation. Now I request Mohit Bhutoria ji, our chairman, to kindly introduce the topic of the day and our renowned speaker Ganesh Balakrishnan ji. Over to Mohit bhaiya.
Yeah, thank you so much, President. Very good afternoon, very good evening to all of you. Today we have a 3-hour session on Schedule 3 and Companies Auditors Report Order 2020, and we have a very eminent speaker, Mr. Ganesh Balakrishnan with us. Mr. Ganesh is the managing partner at Deloitte Heskin & Sells Hyderabad office and in audit and assurance practice, and he has more than 3 decades of experience. He heads the talent and learning and development for the South Asia cluster for the Deloitte audit function. He is also part of the IFRS faculty of the Institute of Chartered Accountants of India, associated as a quality reviewer as well as a peer reviewer, and has been a regular faculty at the Board of Studies of ICI. He is presently associated with Dr. B.R. Ambedkar College and Bhavan's Vivekanand College for review of syllabus in accounts and commerce, has also undertaking IFRS training for Osmania University faculties. He is also a motivational speaker and speaks regularly at UGC, Women's College and other college and universities of India. He has graduated from Osmania University. He is also a certified public accountant from American Institute of CPAs. Welcome, Ganesh ji, at ACAE. Long time back, long time we have the opportunity to heard you, and again, it's a great pleasure and honor for us to hear to you. So, coming on the topic, friends, Schedule 3, Companies Auditors Report Order 2020. So this order, which was applicable for the first time for the financial year 1920, was deferred twice due to pandemic, and finally for FY 22 financial year, this CARO is applicable, and it is very rigorous. When Ganesh ji will giving his deliberation, will all come to know it's very rigorous. More than 40 clauses, including sub clauses, are there now. So auditors will have a very difficult time this year, and much challenges would have to be faced. Coming to Schedule 3, many of the amendments which the government has done in Schedule 3 is in line with CARO. That is, I think, is a savior and a good point for the auditors. But they have come out with large number of disclosures to be made in the financial statements. And when we see the disclosures, we would have a flavor of disclosures, and from the perspective of Benami law disclosures, some of the disclosures from the perspective of income tax law. So a lot of flavor of different laws have also been added to Schedule 3, and disclosures are not one but far and many. So this year we have the financial statements are going to become more and more bulky. Now there are large number of issues which will arise while we are preparing financial statements, giving the disclosures for the first time which are required for Schedule 3. And some pertinent disclosures, if Mr. Ganesh, you can also discuss, is whether we are required to give all the comparative analysis for current year as well as previous year, because we are required to give age analysis of trade receivables, trade payables, capital work in progress. So whether these are required for current year as well as previous year. A number of issues also arise while we are preparing consolidated financial statements. That when we are preparing consolidated financial statements, to the what extent the disclosures which appear in the standalone financial statements are also required for CFS. More so when we have only associates and not subsidiaries. So there was a particular issue which was raised by one of the members that while we are preparing consolidated financial statement which has subsidiaries as well as associates, issue arises while we are giving disclosure for various ratios. And in case of ratios, not only we are required to give what is the ratio for the current year and what is the ratio for the previous year. If the variance exceeds a particular threshold, again we are required to give reasons as to why there is a variance. Now the standalone financial statements gives the disclosure how to deal within this in CFS, because there may be a situation that as per standalone financial statement there was a variance of more than 25% and reasons are given, or there was not a variance of more than 25%, so no reasons were given. But in the different subsidiaries there may be variance. So how to deal with these situations? A particular point was also placed by us while we were discussing concerning inventory. They say if there is a variation in inventory of more than 10%, you are required to the auditor in the company's auditor's report is required to give disclosures. Now the question arises, say if I am following a perpetual system, and they say that for each class of inventory. Therefore, if I am following a perpetual system of inventory variation and not a one-time inventory variation, maybe at year end or at a particular point of time, it may so happen that every month I am picking and choosing 10 or 20% of raw material, stores, finished goods for the purpose of a physical verification. Now the question arises, if I am doing so there may be in one particular month there may be some variation, in another month there may be some variation, or may not be some variation. Do we need to mathematically aggregate all these? Because it's not a case where I say that at one point of time I did a verification for an entire raw material class. So I am doing it across the year over a period of 12 months. So how do we deal with this situation? Another pertinent point was in the context of your reporting to bank. So they say that if there is a variance in balance as per in the returns and statement which is furnished to the bank, and that as per books of accounts, you have to give reasons, deviation. Now the company files stock statement, book date statement with the bank. When it comes to stock, they also give the valuation. Now in the books of accounts, there are no valuation. Then what do we do? Are we, as far as inventories are concerned, are we going to consider only stock, only the quantity, or we are to consider value also? And if you are to consider value, how do you determine what is the value of raw material, what is the value of finished goods, what is the value of WIP? So a lot of questions are there. So we have the guidance note on companies auditors also, auditors report order. So that also addresses to some extent. And as we understand, the institute is again wanting to revamp the guidance note, and they have constituted study groups to dwell upon the revision. So I think this would be a very challenging year, FY 2022, with reference to CARO and Schedule 3. So with this introductory words, may I now request Mr. Ganesh to kindly take forward and start his deliberations. Thank you.
Thank you very much, Mohit, as well as thank you very much, Vivek, for the introduction. And I think you had, I thought we are starting with the Q&A sessions right straight away rather than the presentation. So I do see a lot of questions and a lot of challenges. You're absolutely right, Mohit. I think what's very important is that this is a learning phase for every one of us. I mean, I wouldn't say, suppose somebody would say that, is this the right way to disclose, or is there another way to disclose? Mohit and Vivek, you should be happy that, you would still follow some of this in case if you're not signing any of the larger engagements in the month of April. At least you have certain information that is available already published in the which are listed companies. So you already have those information. So probably that could be one benchmarking. But
Ganesh sir, also we have some IPOs which have come this year. So the RHP which has been filed, the restated balance sheet has all the disclosure. Most of the disclosures are there over there also. So we took the link from there also.
That's what I'm telling. So I'm only trying to say is that, it is not something which is not there, which has been there for quite some time. So I think what is important, let's not look at our response. I mean, I would not want to, in the whole of these discussions, I don't want to look at it from a perspective that is there an additional work that has gone up because of this disclosure that is required under the changes in CARO as well as Schedule 3. But I think what is important for all of us to recognize that the ask by the stakeholders for all these years have now coming back into the financial statements and audit report. Today, if you were to just look at a plain vanilla our audit report in the past and the Schedule 3, Schedule 6 and Schedule 3 up later on, you will just find there is information that is available to the stakeholders or the users of financial statement was just a plain vanilla. He says, I've carried out, and the auditor would say, we've carried out an audit. Based on audit, it's a true and fair view. And the presentation is based on Schedule 6 or Schedule 3, and there is nothing which was available. Today, what is happening is that all of these information which we believed in, so therefore they started introducing what are called as key audit matters. What did you do on these financial statements? So they started with the key audit matter, and the key audit matter also went into a different tangent and saying that we audited, somebody said I audited revenue, somebody audited impairment, somebody audited this and all of that. But definitely these informations were not available with the stakeholders. Now, given all of these, given that there is a lot of activism that is happening across, in the regulatory framework itself, the recent one, which I would say the Company Law Committee report, right, which talked about many of the practicing firms not providing information which is required under the NEFRA, almost equivalent to 11,000. And they said, let's start looking at from a penalizing perspective, saying that we don't have an authority to penalize people who have not submitted us the information. So I think what is important for all of us is this applicable for a standalone? Is this applicable for consolidations? If I were to start from a Companies Act perspective, right? The Companies Act says financial statement on a consolidated basis. It does not even talk about standalone financial statements. Schedule 6, which was there earlier, right, used to have that standalone financial statement. Whereas Companies Act 2013 talks about consolidated financial statements. So therefore, that's where we should start about. So whether it is applicable for standalone, whether it is applicable for consolidation is not something which is a point which you can deliberate till the cattle comes home. But the fact of the matter is Companies Act predominantly is driven from preparation of a financial statement on a consolidated basis. So I would assume all changes that are coming as a part of the Schedule 3 as an amendment to Companies Act is applicable to consolidated financial statements. We'll talk about what challenges. The second thing is we will have whether we should give for current year, whether we should give for previous. Previous year is audited by you, current year is also audited by you. Why should it then ask a question, I will only give for the current year, not for the previous year? It is not something which is beyond. Take for a simple instance, because before I dwell into each of these clauses that is very critical, just take for an instance. When IND-AS was introduced, IND-AS required you to go back and set up an opening balance sheet. It required to restate the previous years. It also required you to comply to the current year in accordance with the accounting standards, right? When the company was when they went and adopted IND-AS, when they provided all this information, why would there be a challenge now to say that, whether we should give for the current period or for the previous period? So therefore, I want to just set the context saying that, listen, this applicability for a moment is applicable for consolidations. Then we will go step by step. And I'll tell you why this is very, very important. I think it's also important where it is impracticable. So the concept of impracticability would come into picture. I agree with you that if there are companies which are running into, let's say 4,000, 5,000, 10,000 companies, it could be large conglomerate, or it could even be there. How do I get this information? Maybe probably I could say, hey, listen, I am not in a position to compile this information because of this. That could be an exception. But as a company could say, hey, listen, we were able to comply to the extent of information. Somebody could question saying, hey, listen, I'm only an associate, should I provide that information? See, the associate application is in relation to, the associate is in relation to a company which holds investment. But the company by itself has to prepare a financial statement which is in accordance with the revised Schedule 3. So therefore, you need to look at all of these in totality. Where there are impracticability, maybe probably we can take, except in CARO, which says in respect of if there are any negative observations by the auditor, you need to bring in. Otherwise, it is more or less it relates to only the standalone financial statements. So let's look at the key considerations in regard to CARO 2020, amendments to the Schedule 3 in 2013, guidance on the Rule 11, which is also, in fact, you should also read in context of the auditor's report itself has undergone change because of the introduction of Rule 11. So I think we need to also focus on our auditor's report. Auditor's report no longer are the same that which was related in the past. And the Q&A, we'll also talk about the questions as it go along. But fundamentally, if you were to look at all of these, when you look at the implementation of CARO, implementation of Schedule 3, if you look at why it got extended, time and again. The first time the CARO 2020 was made mandatory, but the question then came back and said, listen, who is responsible for preparation of financial statement? The responsibility for preparation of financial statement rested with only those people who are the management. It is not the auditors. But how can you make auditors report mandatory and bring out all those informations which the company themselves are not preparing? And that's the reason why it got deferred. And also they made a responsibility statement saying that, listen, Schedule 3 will undergo change and the management is responsible to prepare a financial statement providing all of these information. So that's the reason alignment of Schedule 3 with CARO was done, and therefore the implementation was effective 1st of April 2021, and whilst it went through various stages. Now, when you look at it, CARO is applicable to the standalone financial statement. At least here it is very clear, except for the clause if there are any adverse related information where you would need to include and consider. The principal auditor has to consider in respect of disclosures. The concept of materiality has been introduced, but again, let me touch upon, there have been questions raised in terms of perpetual inventory. There have been raised issues about whether you disclose quantitative, whether you disclose qualitative. Just imagine if you as an auditor provide only information to quantitative, not qualitative, what use does it have to a banker or to the users of financial statement? I think it's important that it is the amount that is important. Then you go back onto the quantitative aspect. So there, I think to answer your point, whether it is quantitative information or qualitative, including the value, I would say it should be including the value. And this is applicable to the whole of report accounting here and is applicable to all reporting for components. That means irrespective of whatever it is applicable. Now, if you look at when you look at the importance of this standard, especially when you look at this. Now, the original objective of introducing this CARO, right, is more determined by evidences. Now, there is a distinction which you need to understand. You have a financial statement which is called true and fair. You have a financial statement on internal control of financial reporting, which is true and fair. Whereas CARO is more on fact finding. It's more on obtaining evidences. I think that is what becomes very, very critical. Now, it is a combination of fact finding, that is, there are certain clauses which has to be based on facts. That means, for instance, does the company maintain a fixed asset register? It's a fact, right? Whether the funds have been utilized by the company for whatever the term loans or loans that they've borrowed prejudicial to the interest of the entity is an information based on your examination. Look at this, evidence that you can cite, information that you can compile and then report on. So therefore, what is important for all of us is when you obtain evidences, for instance, Benami transactions. Benami transactions arises out of either by a survey, either by any of the case, or even if you've identified certain things through your audit procedure, which is generally very rare where you find that. But just in case you found that out, right? It is based on factual, right? So you are now going from true and fair view based on information and explanation to examination. This is a very critical this is a critical aspect that one needs to understand when you start applying CARO 2020. This is evidence-based, and I will touch upon some of the clauses where it is required. There are also, apart from the evidence-based, you also need to seek information and explanation wherever it is required. Now, you cannot have a situation wherein, now I'll tell you why this is very, very important, and somebody raised a very valid point. Why do we need to give ratios? And this is a very important subject, which is we need to understand in totality. In our financial statements, when we give, sorry, not in our financials, in our audit report, when we issue our opinion on the financial statements prepared by the management, we say this gives a true and fair view, right? And these financial statements have been prepared on a going concern basis. Now, when you look at the solvency ratio, that is where the financial ratios that has to be provided, which should establish whether the company is in a position or the company is whose financial assets are available to pay the financial liabilities. One, going concern, you're giving a true and fair view. The other aspect of it, you're commenting, listen, whether this financial assets that are with the company, are these adequate to pay the financial liability? Now, let's say you have a financial assets which is negative. Let's say when I say financial asset negative means your ratios are not positive, it is negative. That means your current assets is, or the financial assets is lower compared to the financial liability. That's a negative situation. Now, you are saying in the financial statement, this audit report says, gives a true and fair view and prepared on a going concern. But at the same time, the financial ratios that you have been commenting on in the CARO says it is negative. Now, this is where you need to start looking at more closely, obtain more evidences. And that is why when you start looking at CARO 2020, CARO 2020 is not a form filling exercise, but it is seeking evidences, examining those evidences, and then commenting on those evidences. What are the broader areas that they've looked at before I get into the detail? One is on the assets, the other is on controls, the other is on related party transactions, and all of the loans that are borrowings that are from banks, then it on fraud and various other aspects of it. Now, look at the report when you say they do not have fixed company has maintained fixed asset register, they carry out a physical verification, there's no discrepancies, there are no Benami transactions, like internal controls are there, but somewhere you have some certain items which are negative. So therefore, when you issue a report, look at the impact of CARO, look at the impact of the Schedule 3 on both the internal control of financial reporting as well as the reporting on financial statement. This is a very critical aspect when you're examining it. Now, you may ask a question, sir, whilst we may be prepared, but the client is not prepared. What do we do, right? The best way for us, what is our evidence? Now, today, let me tell you, with so much of regulations that are going on, one of the ways to look at our approach is to look at what is the guidance issued by the ICI. ICI has issued a wonderful guidance as far as this CARO is concerned, maybe because there are a lot of clarification comes in form of FAQs has also been answered. Take exactly what of this. What are the questions that you need to ask? Mark in that what are the specific inquiries that you want to inquire with the management. As far as possible, obtain all of the responses in writing. Discuss, have a discussion for all of this information that are given by the company. And then whatever basis on which you document it. Today, importance of SA 230 is very, very critical. And that is something which you need to be mindful of. And this is exactly why CARO assumes So once you do all of this, I don't really see that should be a challenge unless there is something which has really gone wrong. So let's look at, those 45 to 47 clauses that came through as there. Actually, it is only 21, but the sub clauses and clauses comes to about 45 to 47 clauses. Now, if you look at this, the first of these items, whether it was CARO, whether it was CARO, whether it is the CARO revised, everything had fixed assets at the addition as the starting point of our report. The only addition that has come through in this CARO 22 is on the intangible assets. It talks about physical verification of property, plant and related material discrepancies. I'll touch upon that. Title deeds was already introduced in the past, but it is something which is assuming importance. And if there are any changes in revaluations, proceedings relating to Benami properties, physical verification of inventory, related disclosures, working capital in aggregate, investments, guarantees, securities. I'll get into more detail as we say what needs to be done from an auditor's perspective. This is more from an understanding. Terms of investments, guarantees, securities, prejudicial to the interest of company, regularity of payments in respect of loans and advances. If there are any overdue payments beyond 90 days, steps taken by the company for recovery. Where the principal business of the company is not in providing loans, whether there has been any rollovers or settlement of any of the existing loans with the issuing of additional loans. Loans, advances in nature either payable on demand or where there are no terms of payments to be provided for. Loans, investments, guarantees, securities, whether in compliance with under section 185 and 186, acceptance of deposit under section 73 to 76, maintenance of cost records, depositing of undisputed statutory dues, disclosure of dues under dispute, recording of unrecorded income when were surrendered or disclosed in tax assessment. This is an important aspect I'll touch upon. Defaults in repayment of loans and advances of the borrowings, whether company is in willful defaulter, and this is a very important aspect, you need to understand this. Term loans used for the purpose for which is obtained, it's been there in the past. Funds used for short term, that means for working capitals raised for used for long term purposes. It was there in the past, but it got revised. Loans, companies obtaining loans on pledge of securities. Securities could include various instruments from equity to debentures to everything. Held in subsidiaries, joint ventures, associates to provide details. Application of monies raised due, including debt instruments. Compliance work under section 62 or 42 and 62 for the preferential allotment or private placement of shares. Fraud reported, whether company is filed under section 143(12), whether auditors considered whistleblower complaints, Nidhi companies, whether they're classified unencumbered term deposit by Nidhi companies, defaults in repayment of interest interest on deposits. Compliance was section 177, 188 of Companies Act related to related parties. Internal audit, whether they are commensurate, non-cash transactions with directors, registrations under 45IA, which is a CIC, core investment companies, valid certificate of registrations under the NBFC or HFC. All of these has to be brought in. Whether cash losses, again, these were in the past, now again been brought in. Whether auditors taking into consideration issues, objections, raised concern, or transfer of unspent money to the CSR, qualifications or adverse remarks. Just look at all of these. These have got significant impact in the manner in which we do the reporting. Now, there have been certain, the red marks which are there. Now, just look at this. When we say that a red flag, that means where you need to focus on those particular areas, right? If you look at internal controls, there are about 5. Proprietary means information relating to the company. Performance indicators, compliances which is relating to by the regulators. Just look at all of these. There are certain things which comes by law, which is about 13. There are certain things which are driven by the company itself, is about 7. There are certain things which are based on controls of the company, it's about 5. There are certain proprietary transactions that are specific to the entity, that's about 10. And red flags about 9, about 35, 40, 45 to 47 clauses. But let me focus on those which are red, so that just for your understanding, right? No, we talked about 9 of them. proceedings related to Benami property and related disclosures becomes your responsibility. Number one. Recording of unrecorded income when surrendered or disclosed in taxes. Whether the company is declared as a willful defaulter by any bank or financial institutions. Fraud by the company, whether in report has been filed in section 143(12), whether as a company auditor has considered whistleblower complaints, whether internal audit reports for the period were considered by the auditors, whether there has been a non-cash transactions, whether there have been auditor taking consideration issues, objections raised by the outgoing auditors. Just look at all of these. These are some things which are for the auditors to look at more closely. Look at some of those internal controls, and then I'll get into the details. Now, internal control, because why this is required, as I said, a CARO has got an impact on the financial statements. A CARO has got an impact on the internal control. So what are those? Maintenance of property, plant and equipment, physical verification, revaluation, physical verification of inventory. All of these would form part of your internal audit commensurate with the size and nature of business. All of these would form part of your internal control. So like this, there are various aspects which you need to look at it. So if you look at from a bird's view perspective, right? And if you look at what are the things that are covered under Schedule 3, most of which are already covered. There are certain things which are where the auditors has to include. For instance, title deeds of immovable property is also required to be disclosed under Schedule 3. Revaluation, if any, more than 10 threshold, about 10% should be given. Proceedings related to Benami property has to be disclosed. Working capital limits in excess of 5 crores. If you look at certain aspects like investments and all of this, all will get covered under part of section 186, because whether it is a part of Schedule 3 or in the notes to accounts, thereon, loans or advances in the nature of the repayable loan also gets disclosed as part of the balance sheet. You look at acceptance of deposits, disclosure is there. If you look at recording of unrecorded income as part of Schedule 3, if you look at it, whether the company has been declared as a willful defaulter, has to be provided, terms utilized and diverted has to be provided, applications of money raised, including debt instruments, should be given. Now, there are various information, either they have been included as a part of the report of the board of directors, or they are included as a part of the financial statements. All of these gets covered as part of the disclosures. So let's look at some of the key aspects of it between under the respective clauses, and I will go by step in respect of that. Now, if you look at the first clause, right, whether the company is maintaining proper records showing full particulars, including quantitative details, situation of property, plant and equipment, right? Now, what are the things that you need to consider? The first and the foremost that you need to consider is all this information that is maintained by the company. Look at the guidances issued by the ICI. Look at the quantitative details that has to be captured and maintained by the company. Look at the information that especially related to those assets that are fully depreciated or those assets which are impaired, and whether quantitative details are there. So all of these, if you look at from a control perspective also, you are looking at from a completeness, you're looking from an accuracy, you're also making sure that the controls surrounding the spreadsheet, because many of the companies in the past are continued even today, maintain fixed asset ratio in a spreadsheet. I'm not sure how many of us have really looked at the spreadsheet controls, because typically it keeps getting updated. We do not know if there are any control features, spreadsheet controls, or it is just that the fixed asset ratio is maintained in Excel without any control. I think these are some things which you need to look at it. Who has got the information, who's got the custody? All of these have to be captured. Now, first and the foremost for all of us is we are used to writing in the auditor's report, and this is commonly used. There's nothing like small firm, big firm, medium firm. Everybody uses this, saying that the company is in the process of updating fixed asset register. Discrepancy, physical verification of fixed assets has been carried out. As and when the fixed asset register is updated, the reconciliation will be carried out and any discrepancy would be adjusted. Just look at this. You've done this year, you've done previous year, you've done 2 years, 5 years, right from the beginning. You take any report. unless the auditor went ahead and qualified the fixed asset register itself, or unless the auditor said the company maintains full particulars of fixed asset registers, details, everything correct, and there is no dispute. Majority of the companies will fall under the other category where the company is in the process of updating property, plant, and equipment. Now, fixed asset has now become property, plant, and equipment. Now, this is where our responsibility comes. If they have been in the process of updating fixed asset register, how is the opinion on internal control of financial reporting? Because under that, the company, every asset that has been purchased should be recorded with all particulars, and there is a control. There's a control for checking, control for authorization, control for recording, control for monitoring. All of these are there. How did we comment saying that if the company is only in the process of updating, when it will happen? Something like saying that India is a developing country, continues to be developing. So this is something which you need to be very, very cognizant about. Moving ahead. Whether the title deeds of all immovable properties, other than the properties where the company is the lessee and the lease agreements are duly executed in favor of the lessee, disclosed in the financial statements, are held in the name of the company, if not, provide the details. This is a very important aspect of it, and somebody asked a question as to how far can we go. Let me tell you, majority of the issues that have come through, right, is coming from the banks. What has happened, and if you know the history, many of when the Companies Act was when the MCA started going for asking companies which are not existing to close, the companies which were defunct companies, or the companies which were not existed, or companies where there were no transactions, right? All of them related to those places and originating for one particular area. There are more than about 4,000 companies originating from one place where all companies were registered in that address under the various names, and amounts were borrowed. Now, this is something what used to happen, that many of the bankers went ahead to the MCA and said, hey, listen, the auditor are the people who have got all of this information. The auditors can examine the funds are borrowed from us and it is utilized, whether it is a term loan or whether it is a loan for acquiring a capital asset. All of these informations are available with the auditor. Auditor can also see if there is a register of charge paid. Auditor can also see whether there is an existence of this asset. Now look at all of these. Honestly, when we are saying the companies maintain fixed assets register, we have validated fixed assets, we say that depreciation is appropriately calculated, we do all of this. But somewhere they found that many of the companies started borrowing funds by pledging their fixed assets with various banks, same assets with various banks. And that is the reason why this issue of availability of original copy of title deeds, and deeds means constituting evidence of right, it is basically a legal right, getting a confirmation from the lender saying that this is what it is. If the assets are lost, whether there is an FIR filed, disputes, if there are disputes, if they're based on the legal documents, all of these have to be examined. So somebody said, sir, this company has been there for 100 years. Is it necessary that I go and verify all the 100 years? The answer is 100 years is some. I said, if you take 100 years and if you take Companies Act itself on depreciation, right? Depreciation itself, majority will go on 30 years, 40 years, right? And if you've got large buildings and plants that are already in existence, so you need to segregate between those which are tangible, which are movable, which are immovable. If immovable properties are all there, it's already backed up by title deeds and documents. I don't think so it should be a challenge. It is only a challenge when you have movable properties, and movable could be assets, could be various things, could be furniture, could be your equipment, could be anything else. But it's very rare that it'll keep moving unless like a laptop which keeps changing. So I think it's very important that for all of these, you should be able to identify if there are any titles. Somebody might say, sir, title deeds are basically for properties. The answer is yes. But when you look at certain properties, other than even your assets, could be on a leased assets, right? For instance, you could have taken a fixed assets for, let's say, on a lease basis. Even those property deeds has to be verified. So therefore, it is important for all of us is where there is borrowings that have been taken, you need to get the confirmation from the lenders without exception. You need to verify the register of charges from the ROC and get that update. This is a very important aspect. Because without getting these informations, you will not be in a position to validate. Where you are not in a position to validate the title deeds, that's for instance, you may need to bring the attention, say that in respect of these particular assets, this is the amount you've not been able to identify or validate the title deeds. Therefore, you'll bring an attention to the extent in the CARO report. It's a very important aspect. Now, determining the validity of title deeds. Now, let me give you another example. Typically, many of the companies which seek loans, right? Using a project report or even using, when they go for restructuring of loans, what do? They basically, what they do is they say, okay, fine, your promoter's contribution should be X and the lender's contribution should be Y. They say, the promoter says, okay, fine, I will get you my land. But he will never transfer the land and register in company's name. If you see majority of the times, there are a lot of securities which are given, which are where the properties are in the name of the promoter, but not in the name of the company. And this becomes a very critical matter. And that is the reason why we need to spend more time examining this document. Whether the company is revalued and it is in excess of 10%. Now, there are a few things which you need to be very, very cognizant about. First and the foremost, when you're doing a revaluation, in the earlier period, you could have got revaluation done for anything and everything. But once if you're on an Ind-AS revaluation model, you have to be continuously on revaluation. But if you've done a revaluation, it has to be done by a competent registered valuer. That means, the registered valuer is as defined under the Companies Act becomes very, very essential. So therefore, any one of those who are registered, who fall under the IBBI, all those registered valuers, whether they are competent enough to carry out this valuation. And if there are any differences, provide the details in excess of 10%. And this is a very critical aspect that should be disclosed. Whether any proceedings have been initiated or are pending against the company for holding Benami property. And typically it happens, I wouldn't say that whether it will happen to companies which are multinational companies or companies which are, so typically what happens is it is more driven from a tax evasion perspective. If you have there are any tax evasions, typically what happens, if any of the companies that are auditing, or if any of those companies where the properties are held in other than the name of the company, it could be held in some X, Y, and Z. I think if it is examined and basis of where through a survey or through any of the finding, you come across that the properties are held, or your own properties are held by another name, those who need to be brought in. Now, this is let me bring this about. It's a very important aspect of it. Now, why is this important? Benami is not only in India. You can also have situations where assets are held your assets are held in others' names. And this becomes a very, very critical issue. Now, if the reporting would be required, even if there are any proceedings that were initiated in priors and they were closed, I think this becomes a very critical aspect of it. There would be a lot of sessions which would have been conducted by the ACEs or your study circle in respect of Benami transactions. Again, these are all Benami transactions, is again defined under the Benami Transaction Prohibition Act of 1988. But I think what is important is the part of the disclosures is you need to give the nature of property, you need to bring the carrying value of property, status of proceedings with the relevant authority, consequential impact on the financial statement, if the liability is not disclosed, all of them. I think this becomes a very critical aspect of it. I would not expect many such information coming here under this, unless there have been certain instances where there's gone through an ED route, where it's gone to a CBI route, or through an income tax scrutiny route. Probably you will find more of that, but this is something which you need to be cognizant about. It's not only in India, but outside of India. There's a detailed guidance note which has been given under the ICAI guidance. It talks about what properties which are subject matter, what to be included, under whom this has been held. I think what is important under section 8990 of the Companies Act 2013 that talks about those connected people, persons, and that becomes a very important aspect of it when you're looking at it. And these are the specified people that gets defined where these beneficiaries would be there. These are the specified people where the beneficiaries would be included. I think that becomes a very critical aspect of it. Now, one question that came through in the earlier discussion was physical verification of inventory has been conducted at reasonable intervals. And if there are any discrepancies, 10% or more in aggregate for each class of inventory. Each class means raw material, work in progress, finished goods, all of these, how these has been dealt in the books of accounts. Now, there are certain things, again, if it is forming part of the property, plant and equipment, it will not be included here. It is other than those inventories for which you want to generate the production of goods, and therefore which is ultimately gets sold. Perpetual inventories, definitely 10% becomes a very critical threshold. Now the question then really comes up, right? Now, I would say that in a perpetual inventory, you would still find 10%. So 10% is in the value perspective. It may not be in the quantity perspective, but it could be in the value perspective. So should you include 10% because let's say by quantity wise 10% more, but value wise it is within that route, it is not. So probably it will not get covered in respect of that. But discrepancy, you need to evaluate those discrepancies and see how it is done. Now, one of the key aspects of it when you do inventory verification is not done on the basis of from whatever is in the sheet to flow. Inventory verification has to be done also from floor to sheets. This is something which has to be very, very critical. So when the physical verification is conducted, you should see the process of physical verification that has been established by the company. Look at each of the manner in which is done, the nature of the reports that are done. If you say it's a perpetual inventory because the inventory keeps changing significantly, I would rather believe that it is more driven from the raw material stage because the volume could be higher. Where the volumes are not much, but where the incidence happens at a quarter period or a year-end period, it's much more easier to capture this information. But 10%, be mindful, it is not at the overall level of inventory, but every class of inventory that needs to be considered. The other important aspect that has been brought in under the clause 3(2)(b) was in respect of any of these loans, working capital loans in excess of 5 crores in aggregate from banks or financial institutions on the basis of current assets, whether quarterly statements are statements filed by the company with the financial are in agreement. Now the question is, this is a very important point, and this is a very valid point. A lot of people have raised this, saying that how do we reconcile this aspect? Now this is a very difficult aspect. Especially when such companies do not have a quarterly closure, or such companies don't even consider the auditor, the auditor will go only after the year end and try to see. And this is where we need to be cognizant about. We need to be mindful that if there are any loans, please tell upfront now itself and say, listen, every quarter, whether you reconcile it, it has to reconcile with all the information that you're filing. What are the information filed? You will give receivables information. You will give payables information. You will give inventory. You will give loans. You will give all of that information for the withdrawal of fund-based facility, right? Now, what is this threshold of 5 crores? And threshold of 5 crores is a very small amount. It only says sanction. it does not say, that means you've utilized, it is, even if you've got 5 crore sanction, if you're not utilized, still you need to file this information with the bank. And I think this becomes very, very, it is not withdrawal or drawdown of those facility, but it also means that if you have given a sanction means the company has been given a letter for a 5 crore fund based or a non-fund based. And that becomes the basis for us to make sure that the company provides this information regularly. How do you compare it? You would say based on audited, unaudited. So unaudited information based on this. But you may have a situation where for all the 3 quarters, it is not tied up, but at the 4th quarter, it's reconciled. The responsibility is on you saying that, hey, listen, these are the quarters where there was differences. How are these differences reconciled at the year end? And that becomes a very critical aspect of it. There's a host of things that have been included. What is financial institutions? What is included? Again, this has been brought under the RBI Act of 1934, which brings about a host of things. Next, whether the company during the year has made investments, provided guarantees, security, or granted any loans or advance in the nature of loans, secured or unsecured to companies, firms, liabilities, limited liability partnerships, or other parties. Now look at the expansion that they've given, right? Companies, firms, limited LLPs, or any parties, if you've made, the company has made any investments or provided any guarantee or granted any loans in the nature of loans, right? You can't just say that, loans with related parties. No, you have to go to the entire cash flow or an entire balance sheet in respect of financial transactions where you have lent. Somebody might ask a question. Does advances to suppliers come under nature of a loan? If the advances to the supplier if is not recovered, as if supplies have not been made, probably even that would get covered. So therefore, the focus is not restricted alone to only the related party transaction. It's the entire spread which you need to look at it. Now, and you have to also be mindful. If let's say if any of the internal auditor says the loans that have been funded are not backed by any agreement or a guarantee or any interest, that becomes a critical aspect of it when you're dealing with it. So therefore, when you're looking at investments or given even a guarantee or a security or any loans in the nature of loans, whether it is secured or unsecured, you have to provide this information. Now let's look at what you need to report, right? Aggregate transactions during the year, the loans, the nature of loans, guarantees, security, investments, transactions, balance at the end, balance relating to previous years. Question was asked whether we should give for the previous year. The answer is yes, because when you present a financial statement, you present a financial statement previous year figures as comparative. So when you're providing that, information has to be provided even in respect of those. Now, if you look at if there are any investments in the or guarantees or securities, whether provisions of section 185 or 186, which are basically to the security loans to the directors or to the companies, have been complied with. If not, provide the details thereof. Now, look at from both perspectives. This has been there. I don't want to spend much time, but just look at the focus. It's not only the loans investment guarantee, but the entire spectrum of this which is to be included. Now, while some might say that the wholly owned subsidiary is excluded from all of these, but this information has to be covered as part of our understanding. So, prohibition of loans and advances guarantees permitted only if special resolution passed. So what are the controls perspective you need to look at? Look at the compliance with laws and regulations, whether is in respect interest is not prejudicial to the interest, whether for what purposes the loans have been given. All of these information should be discussed with those charged with governance. And I think this compliance with section 185 assumes important. And I'll tell you why this is very critical. If you look at the rule 11 of the Companies Act, which brings in the auditor's report, also talks about lending of loan and the end use of funds in respect of those loans and investment. Now, The other aspect of it is in respect of the deposits accepted by the company under section 73 to 76. In relation to the deposit company's deposit rules, you have to see whether all the compliance relating to deposit rules have been complied with or not. And again, this is not something which is different. I'll just skip for the from an importance perspective. The other aspect of maintenance of cost records is also not a significant part of it. It's been in the past, it's just maintaining, and then you don't really comment upon it, but just you do a review of the cost records and a reconciliation with the financial statements. Now, this is where the statutory dues clause is very, very important. When you look at this clause, whether the company is regular in depositing undisputed statutory dues, including GST, employee state, provident fund, employee state insurance, income tax, service tax, duty, customs, and all of these. And these have been outstanding for a period of more than 6 months. Now look at this undisputed. See, when we say disputed and undisputed, right? Merely because I've got a letter does not mean there is a dispute. A dispute is where the issue is arisen because of where there is a disagreement or an application of that. So I think what is important for the company and for the auditor also is to examine each of these cases to see if there are anything which are undisputed. We'll talk about disputed separately, but identifying the statutory dues itself, tracking the statutory dues itself. You might say that the shop and establishment rates have not, shop and establishment in respect of shops and establishment, whether that will come under or any other tax or cess would come under. Ideally, you need to evaluate from whether it's a statutory due. That means if it should be covered under Shops and Establishment Act, whether that has been covered or not may also be considered under this aspect of it. So the obligation to pay a statutory due is basically nothing but which is either by a statute through a central, state, or local, or any foreign, or it could also include municipal taxes, licensing fee, and all of that. All of these would be coming under as part of your reporting. Now, we have to be mindful that assuming that, merely because you sent a letter or notice doesn't mean it is disputed. You need to look at it. Dispute means you need to give the forum or the tribunal in which it relates to. And I think that is a very critical aspect of it. Where statutory dues referred to have not been deposited on account of any disputes, then the amount of disputes, this has already been there. So therefore, I'm not specifying more on that. But just to be mindful on this clause 7B, it is important that all disputes are now required to be reported, whether it's PF, ESI, and all of this. Even those not made also to be reported. Now, there is no distinction because it is 100 rupees, 5 rupees, 100,000 rupees, everything gets to it. Status of disputes is very important. Critical possibility the dispute would have got settled, maybe too. Even if the payment has been made after settlement, after the subsequent to the reporting date, you may have to include all of this. So the reason why this is important is for each of the client that you audit, you need to have an understanding about the entire spectrum of what are the statutory payments that the company has to make. In fact, if you were to make an analysis across in India, there are more than 4,000 laws a company has to comply if it is operating pan-India. Could include both state, central, local, municipal, everything gets included. But this becomes a very critical aspect of it when it goes to monitoring. Now, coming to clause 3.8, whether any transaction not recorded in the books have been surrendered or disclosed as income during the year under Income Tax Act. If so, whether previously unrecorded has been properly dealt. This is a very dangerous clause. I would say it's a dangerous clause. Suppose you neck yourself out and say, hey, listen, hey, the company went ahead and disclosed X income, and therefore they paid a tax. Now, these are not recorded. You have issued an opinion in the past year saying that gives a true and fair view. You've issued an opinion on the internal control of financial report. Now, when you are looking at this aspect of it, how does this impact your financial statements? one has to examine this. This is a very critical aspect. Please do not just merely because no sir to buy peace with the income tax department, my company went ahead and disclosed and therefore they wanted to buy peace. The company has bought peace. You will not be able to buy peace because your responsibility is what will happen to my opinion, which I've given in earlier years. And if this says these were not recorded, then how did we comment on the completeness of the books and records? And how do you know that similar issues will not arise in the current year? I think this becomes a very critical aspect of wherever you get such instances. My recommendation is, first of all, internal control of financial definitely has to be qualified to examine whether you need to restate this financial statements, because the restatement means to the extent of only tax part of it, because that becomes a very critical aspect of it, and you need to look at this very, very carefully. Next, clause 9A, whether the company has defaulted in the repayment of loans or other borrowings or in the payment of interest thereon to any lender. Okay. Here is a company which has got a consortium loan across from various banks, right? It's got from ICICI, it's got HDFC, it's got SBI, it's got Corporation Bank, it's got Indian Overseas Bank, it's got Indian Bank, it's got Cooperative Bank, it's got everybody. Now the question then is, whether the company is default in the repayment of loans or borrowings and the payment of interest, how do you identify? Do you know that how much of the loans have been given or taken by the company? Do you examine the company secretarial records? Do you validate how much is related to principal, how much is related to interest? Do you have a tracking mechanism? Does the company has a tracking mechanism of how the funds are utilized? Does the company provide you the reasons of there are any defaults? Now look at all of these. In the when you disclose under the debt, right, long-term debt and all of that, borrowings especially, you may say, hey, listen, this information is information what is provided by the company. But when it comes to default, should you not get a complete list of the loan covenants? Based on the loan covenants, should you not get a list of the entire banking installment details, repayment details? Should it also not got a confirmation from these so-called lenders? I think this becomes a pretty essential, because when you talk about lending, right, we talk about term loans, we talk about demand loans, we talk about export credits, cash credits, overdraft facilities, bills purchased or discounted. This becomes very, very, except for preferential share capital, most of the borrowings would be included for reporting. Next, when you look at clause 9B, whether the company is declared a willful defaulter by any bank or financial institution or other lender. Who is a willful defaulter? A willful defaulter is where a person has continuously been defaulting in repayment of loans or interest or siphoning of funds and all of this. So I give you an example of that. You're operating pan India, you've got so many banks. One banker has not confirmed. The company knows they have defaulted. They have not confirmed to us. If you have not confirmed to us, or confirmed as a part of the auditor, when I say us, is the auditor. Now, the rest of the banks have given, the rest of the consortium have given a clear chit. Even if one bank in their own say that this bank is under willful defaulter, typically the way it happens, the company borrows from, let's say, A bank. A bank says, this is the rate of interest, this is what it to be paid. But what really happens is, the company is defaulted. They say they want to recall. The company A goes to another bank and says, listen, I want you to take over all of these loans. So take over all these loans and repay this bank. Now the question is, was there a willful default? If there was a willful default which has been declared by any bank, then those should be included, whether it is by banks or financial institution or any other lenders. Now, this is something you need to be mindful of when you're doing it. Somebody might say, I can do a credit score of the of these loans, right? Or there are rating agencies who provide this. So this willful defaulter, be mindful. Merely settling of a bank loan with another new loan does not mean that they're not willful defaulters. There could be potential willful defaulters if they have been defaulting in respect of these loans, and this becomes a very critical aspect of it. Be mindful of that part of it. Coming to clause 39C, whether the term loan were applied for the purpose for which the loans were obtained, if not, the amount of loans or diverted. Provide this information relating to diversion. Now, reporting in the year is in respect of a term loan which is issued both. It is about only utilization of a loan. You could have got a loan in the previous year, all right? If you got a loan for the purpose for which you're utilizing it, you have to bring this aspect of it. Now, what do you mean by diversion? Okay, so you have taken a short-term loan, a working capital loan, or you've taken a short-term term loan, right, for purchase of an equipment, but you've utilized it for, let's say, cash credit, or vice versa, right? Term loans taken to be applied for purpose for which it is taken. You might say, listen, it is only a temporary, therefore it will not be covered. The answer is no. It is very important that every term loan that has been taken, look at the loan covenants. The loan covenants will provide for which it has been taken. So put all the loan covenants, look at the utilization. You would say, sir, there was बहुत emergency था, sir. We had to use it for working capital. Therefore, it is only for 5 days we have to. Even then, the reporting would be required. I think this is a very critical aspect. That's why I'm saying this is examination of evidences. It is not examination of obtaining information and explanation. It's examination of evidence. Examination of evidences brings you the fact that you need to look at each of this clause very closely. Now, diversion of funds is being defined under the RBI. Just take a moment to understand. Utilization of short-term working capital from long-term, not in conformity with the terms of sanction. Deploying borrowed funds for purpose active of creating assets other than for which loan was sanctioned. Sir, we borrowed this term loan, we are waiting, but we have now gone and deposited in a mutual fund. Transferring borrowed funds to subsidiaries, group companies, or other corporates by whatever modalities. Now, this is a peculiar situation which happens. You have applied to a bank loan and you say, I have taken this term loan for acquisition of capital asset, right? Now, when you say you're applying for capital asset, right? What is this capital asset? Sir, listen, I want, since my subsidiary is not doing well, so therefore I've taken this loan on capital asset from my parent company. I have transferred to my subsidiary, so therefore there you purchase the asset. But the point is, what is important here? Whether this term loan was taken with an intention to fund your subsidiary to acquire a fixed asset or a capital asset, or whether this term loan was taken for funding your own capital asset. I think this becomes very, very important. Not only this, routing of funds through any bank other than lender bank of concern without permission of the lender. That means what you do, you take the loan, there is some loan which is of the bank you have not paid. So it is getting default. You divert it. You say, sir, our working capital aayega, but till system I want to pay, so therefore we are not defaulted. I hope you understand. So the whole issue that comes through it is, it's very important when you're saying diversion of funds, anything even to a bank other than for what it's meant also would be considered as diversion. Investment in other companies by way of acquiring equity test instrument with approval lenders, shortfall in deployment of funds vis-a-vis the amount disbursed, drawn, and differences not being accounted for. And look at all of these. That's why I'm saying when you put the lens of an auditor, be mindful that this could impact us on a reporting basis. Next, 3.9 clause D, whether the short-term funds raised by short-term basis have been utilized for long-term purposes. If yes, bring it out. Now look at this aspect of it. How do you identify this? There are two ways to do it. One way is I can go and do an exact examination of bank accounts, especially the bank from the bank statement, go on ticking where the funds have been utilized. What are the short-term, your working capital loan, packing credit loan, all of this. Now the other way around is you can look at it from a perspective of, I will take my cash flow. I'll say operating activities means I've generated from internal accruals. So therefore it is completely on that basis. And therefore it is a long-term, not a short-term. The other alternative is do a mapping between how much loans I have as per liabilities and look at what is as per my assets. I can look at various aspects of it. Now, one of the things which is very important is whether you classify short-term or long-term is not determined based upon at the end of the year. You don't classify between a current asset and you consider it only at the time when you draw down the loan and say, hey, listen, this is a long-term fund, this is a short-term fund. And this is something which is very essential. Next, when you look at clause 3.9e, whether the company has taken any funds from any entity or person on account or to meet the obligations of its subsidiaries, associates, or joint ventures, if so, details thereof with nature of such transaction and amount in it. Look at this aspect of it. Earlier, we used to only have information relating to companies and all. Now, the reporting is gone to subsidiary, associate, joint venture as defined under the Companies Act. Right? So, if you have taken any funds from any entity or any person on account to meet its obligation, that means it could be intercorporate, it could be your personal, it could be any, or it could be a bank, it could be anybody else. You've taken that money to invest in subsidiary, associate, joint ventures, you have to provide all of this. All funds taken during the year, even if they have not been repaid, you have to provide all of this information into this report. So therefore, it is important that when you look at this loans, especially when somebody asked me in the beginning, the question is, sir, how do we report on those information relating to associates, joint ventures, where information is not available? Look at this aspect of it. You have taken a loan and given to somebody else. Would you mean the company will not have this information with you? The only point is that the company would say, listen, I don't know how much is the associate handling it. I think it is very incorrect, because the moment if you look at it, every company, when they do it, any transaction which they enter, they will do it with their knowledge. It is not that something which has happened just like that. So therefore, it becomes very, very essential. Similarly, clause 9F, whether the company has raised loans during the year on pledge of its security held in subsidiaries, joint venture, or associate, if so, give the details. Now, you've got subsidiaries, you've got joint ventures, you use their shares, you use this thing to raise funds by pledging it, right? Now, this is where you need to be very, very careful. If it's a corporate entity, right, register of charges is a very critical aspect. Pledging of shares is all of these information you should be able to do it. Understand the pledge and securities. Securities includes a host of things. Loans will include both long-term and short-term taken from any lender. Reporting will be required for all loans taken repaid during the period, even before the year end. You cannot just state that yes or no. You have to give all the details, whether they have raised funds, whether if yes, you need to provide all of the details continuously. And it's a very important aspect. When we talk about securities, we talk about various aspects, including shares, derivatives, securities as defined, government securities, everything. Let's look at clause 10B, at 10A. Whether money is raised by way of initial public offer or further public offer during the year were applied for the purpose for which these have been raised, if not details together with delays or default and all. These are basically for IPOs. In fact, the Vivek was mentioning about a lot of IPOs coming through. All of these information have to be captured as to what was the purpose of IPO, how it has been utilized, all of this. And for all of us as auditors, make sure that whenever you have an IPO, the purpose for which is claimed, make sure you obtain the bank confirmation at all times. Make sure you get the bank statement with you, not only the confirmation, everything at all times. Make sure that you identify each of these transactions for which it has been raised and how it has been utilized. It's a very important aspect of it. In fact, you need to look at the ICI guidance note, look at the basis on which the disclosures have to be made. From a control perspective, look at the monitoring fund utilization, look at the authorization for approval of funds. When you look at clause 10B, whether the company has made any preferential allotment or private placement of shares or convertible debentures partially or fully or optionally, whether the compliance under section 62 and have been complied with and the funds raised have been used for the purpose for which it is meant for. See, look at now all of these, all of the disclosure that we are talking about today. We are talking about the end use of funds. We are saying, you see, look at our responsibility. Earlier, our responsibility was only restricted whether in the company has paid, if yes, reported with the details. Today, we have to go and examine the evidences. If you have to go and examine the evidences, whether listed, unlisted, all, whatever it is, you have, as an auditor, has got much more responsibility to address than what it has been. Private placement and preferential allotment is as defined under the Companies Act. I'm not getting to it. So let's look at the most important aspect relating to whether fraud is under section clause 311A. Whether any fraud by the company or any fraud on the company has been noticed or reported during the year. If yes, the nature and amount were to be indicated. Now, this is a very important aspect of it. What is fraud? Fraud has got a definition which is encompassing a lot of things, right? Fraud could be by an employee, fraud could be a management, fraud could be with the customers, fraud could be with vendors, fraud could be with the auditors, regulators, anybody else, right? The whole objective is, for instance, if you're paying cash instead of check, if you are entering into transactions of any commercial transaction without involving the GST, I'm just giving you just an example. Is that a fraud? Every commercial transaction has to go through the GST invoice, but whereas the company does 80-20. 80 with GST and 20 with cash. Is that a fraud? The answer is yes. You might say, sir, the company, those people don't have bank account, they do not know, they do not, that's all fine. You as a company has got knowledge about bank, you have a company about GST, you've got a company about all of this you have. Why have you not generated a GST invoice? Cash is okay, different. The farmer doesn't understand, this person does not understand, the trader does not understand. Now, this is a very important aspect. I'm telling you why this is coming back time and again. Unfortunately, auditors were considered to be a watchdog, The regulators expect auditors to be bloodhound. Now the question is, and some other I would say some other people who speak about us saying that at least not be a bloodhound, be a barking dog. Now look at ourselves. First of all, we are auditors as professionals. We are not dogs. So they're bloodhound, barking dog, or watchdog is all not important. But now with this introduction saying that every auditor has got information about the company, he or she shall report. Take the case of simple example of tax audit, right? 40A3, or any transaction where the cash is in excess of 2,000 or 20,000, all of that. We know there are transactions, but we say these transactions are not, we have done on a test sample basis, and these are not under this. These are very, very important aspect of it. And I'm telling you, the regulators are coming back only on this aspect of saying that auditors are in the knowledge. Honestly, auditors are not in this. Maybe in instances you mean knowledge, but if the volume of transactions is such huge, the majority of the transactions are through checks, it's very difficult to find out. But today, under the 143(12), right, and section 240 of the auditor's responsibility to legal compliances, the auditors is supposed to detect fraud and detect and report fraud. And I think this becomes a very essential aspect of it. Now, another aspect of it which has been introduced in this clause 311B is in respect whether any audit report under section 12 of 143 has been ADT4 has been filed with. I think so far there are very few companies, very few auditors who have filed this information. But just imagine if there are any fraud that has happened in excess of 1 crore, that has to be reported to the offices of the central government. And I think that becomes a very critical aspect of it. Now, this is something beyond any auditor of all this whistleblower complaints. Now, if you look at the whistleblower complaint, right, a whistleblower actually is basically for a listed company. So in many of these listed companies, you have this aspect of it. So what does a whistleblower do? Right, a whistleblower is basically under the Companies Act, especially if you're a listed company, or if you're accepting public deposits, or if you've got borrowings in excess of 50 crores, you need to have a vigil mechanism. Under the board report, under section 134(5)(e), you need to provide all of these informations. Right? As an auditor, if you've got many of the companies that are more than 50 crores, you need to have a vigil mechanism. So how do you know it? How do you know that whether they have what manner has this complaints come to? See, many of the frauds that have been detected so far in any of the companies or come to light within the companies are only through outsiders, through whistleblowing complaints. And a whistleblowing complaint is where somebody who knows from inside that there's something going wrong and therefore it is an impact. So it is important for all of us as auditors to be mindful, especially in relation to those vigil mechanisms where there are information that is provided to us. And I think that's a very important aspect. Next clauses relates to Nidhi companies, where the ratio of 1:20. Again, this is more applicable where there are banking financial institutions, companies where there have been defaults and all of them would need to be looked at it. But I think Nidhi companies, again, becomes the auditor's responsibility is to make sure that you respond on and report on the defaults which is existing at the year end and during the period, and it's a very important aspect that's going to be covered. Now, related party transactions. Now, this is something which we as auditors have to be mindful about this. Related party transactions are focused time and again by every regulator. Now, how do we identify this regulations? Now, let's look at some of the aspects of it. You will, if suppose the company comes to you and says, listen, there are transactions with these people, how do I ensure that they're outside the related party? So you go back and give the scheduled information, which says which are the parties which are within the chart of saying that these are related parties who are not outside related parties. If you have given, that is another issue. But let's say you have not given, but you have to identify it. How do you identify it? And this is a very important aspect. You will have to examine every transactions which are abnormal, which are substantial. So let me give you an example. How do you identify it? Now, one company in which you're doing an audit, find that there's a new party who has been added, and you find that majority of the transactions have gone through with that person, right? When you look at that party is actually, you would have evaluated and say it is not related. The company would have evaluated and say it's not related. But the nature of transactions are such that you are paying more than what is you're paying a premium more than what is the market demands. So let's say the property in which I'm acquiring, let's say I have to pay a rent of 1 lakh rupee, right? But I'm paying for the same property about 5 lakhs a month. Now the question that should come to you, whilst you are saying that it is not a related party transaction, whereas if you look at it from a perspective of the nature of transaction, it assumes, why would somebody pay 5 lakhs for a 1 lakh property which is available elsewhere? This is something which you need to examine. It is examination of evidences. Examination is not saying that whether it is a related party based upon mother, father, father-in-law, brother-in-law, father, son, grandchild. No. Examination of a transaction to establish whether this will still fall under the related party transaction. And that is the responsibility of the audit. Every unrelated transactions which actually is in the nature of an undue influence. For instance, you are entering into a transaction for sale of goods or services. This person is a newly incorporated, does not have funds, does not have assets, but he has been buying material. Now the question is, if you have not evaluated his financial capabilities, why are you substantially supplying to that party? That becomes a very essential aspect. So this identifying of a related party and a related party transaction, you need to be very careful in examining every transaction that are recorded. And every transaction in the nature which you believe are not at arm's length, are such that which you believe that it is actually more towards a related party, then you may need to comment on. And it's a very important aspect. Now, the other thing which has been included is the internal audit system, whether they're commensurate to the nature and size of its business. Whether the reports of the internal auditors have been considered by the statutory auditor. Now, you will have to be very careful on this. The statutory auditor says that the sales orders are not numbered. You would say some of the vouchers are missing. Some of the transactions are not authorized. Bank reconciliation is not done on a regular basis. Okay. And you look at the financial statements. And so you look at your audit report. The company we have examined and gives a true and fair view. You give your internal audit, we say without a clean report. Now the question is, internal audit says nothing is there, whereas the statutory audit says everything is there. Till last year, you did not have internal audit. Now you have to consider all reports which are by the internal auditor. It is not only commensurate with the nature size, it's not about use of work of internal auditor, but you have to see whether the internal audit system itself is good, or if there are weaknesses, and how do you deal with it. And it's a very important aspect of it. Clause 15. Whether the company has entered into non-cash transaction with directors or persons connected with him, or if so, whether Section 192 of Companies Act have been complied with. Right? With the directors or persons connected with him. Right? There are restrictions on arrangements to acquire assets from a director of the company, of its holding company, connected with for a other than cash, unless the arrangement is approved by shareholders in the general body. And this is a very important aspect of it. That means if there are any transactions that have been entered into any non-cash transactions, you need to identify that. Clause 17. Again, this is related to CIC. This is more driven from Reserve Bank of RBI. In respect of any CIC assets more than 100 crores, all of these needs to be complied. Next, clause 16 talks about especially about whether the cash as company has incurred cash losses, whether the cash losses have got an impact. Now the question is, the cash losses have come back. Now, so let's take some of the issues that came up during the period. You say the company has got cash losses incurred. Then you look at the solvency ratio, which is your financial ratios, and say any variance is more than 25% to be explained, both in Schedule 3 as well as in the auditor's report. Now, if you've got cash losses, does your audit report say the company financial statements are not prepared on a going concern basis? Because if you've got cash losses, how are you going to pay the debts? On what basis? How are you going to pay all your creditors? So if there are cash losses, you might say, listen, these cash losses are there mainly because the company is in construction phase, the company is during this phase, so therefore there could be potential cash. Or you might say, listen, the cash losses is because I'm only transacting with my parent company, so therefore there are cash losses. But it is very important to understand the reason why there is a cash loss, and you should also connect it with financial solvency ratios. You should also connect with your going concern section, SA 57. These are very, very important aspects. Next, this is an important aspect for every auditor who has become the incumbent auditor. Now, with this, if you really see the committee report, which is now being in circulation for comments, one of the asks that they've asked is, if any auditor is left in between, why would an auditor leave? Why will it create a casual vacancy? He will create a casual vacancy because somebody has acquired, or he might say, listen, there are a lot of problems with this company, so therefore I don't want to do the audit. This is a very important aspect. If there are any casual vacancies that are filled in, the auditor, outgoing auditor, and the incoming auditor. Outgoing auditor has to provide the reasons as to why he is resigned. The incumbent auditor has to look into the issues, objections raised by the outgoing auditors. Somebody says, sir, I've left it because I don't have time to carry on, because busy, preoccupied. Somebody would say that. The point which is important here is, if you have become a new auditor, and let's say many of these audit changes happens when? After the year end. Think through all of these. If you become an auditor after the year end, you have not carried out physical verification process, you have not carried out opening balances, you have not sent out confirmation of balance, how are you issuing an audit report? This is a critical aspect of it, which has to be examined by every chartered accountant firm before they accept any engagement which is done by a previous auditor, where the appointment is happening after the year. And this is a very critical aspect. This is the most important aspect of it, clause 3 of 21. On the basis of financial ratios, aging, and expected dates of realization of financial assets and payment of financial liabilities, other information accompanying the financial statements, the auditor's knowledge of board of directors and management plans, whether the auditor is of the opinion that no material uncertainty exists as on the date of the audit report, that the company is capable of its meeting its liability existing at the date of balance sheet, as and when they fall due within a period of 1 year from the balance sheet date. This assessment under SA 570, you anyway do it. Now you have to bring all these ratios, current ratio, debt equity ratio, debt service ratio, all of that. And then say whether this ratio would result into the company not in a position to repay. That means if there are material uncertainty, that means they're not in a position to recover, they're not in a position to pay any money, they're short, they're not getting supplies, they're not getting people, they're not able to sell the products, they will not be able to pay this liability. That means now, look at this aspect of it. When does, if you're now, because all of you would have done the bank audits, right? In a bank audit, your objective is to look at NPA. But when you do a statutory audit, your company is to make you audit because saying that the company is on a going concern. Look at the flip side. So when you look at the flip side, if your position of an NPA versus the company to saying that it is to be on a going concern basis, it is no different. Today, the responsibility will be on the auditor. If anything goes wrong on that day, any bank or financial institution, everybody comes and says, you had this information, you did not disclose this. This is a very critical aspect of it. Please do not calculate ratios and say this is true and fair and be done. No, you have to be evaluating the evidences. Basis on evidences, you need to provide this. Again, the clause on unspent on section 20 talks about ongoing projects where they've been unspent within a period of 6 months from the end of the expiry period, whether within 30 days the amount has been transferred, whether it's an ongoing project within 60 days. These are some things which you need to look at as far as the CSR is. There are certain, because of COVID period, there has been certain relaxation in terms of, carry forward of the excess period during the earlier period. There is something which is a benefit the companies under the Companies Act has been provided. But it's very important now, all of the CSR, in fact, the government is looking to get the CSR audited itself. All of the CSR funds to be audited by the auditor. So they are planning to examine that aspect of it. When the audit comes, every amount that has been shown as towards CSR, if there are any qualifications, then it becomes a big challenge for the auditor community. Because even for the auditor who has signed the accounts, even for the person who is reporting it. Now, whether there are any qualifications, now this is the last of the clauses which is very important, is whether there are any qualifications or adverse remarks by the respective auditors in the company's auditor's report, or CARO, included in the consolidated financial statements. That means if there are any qualifications, it could be qualification on fixed assets, it could be qualification on inventory, it could be qualification on statutory dues, it could be adverse. The moment it says adverse means qualified means adverse. All of these, you need to look at it from that perspective and include it. For instance, right? A qualification or adverse income would not necessarily result in modification audit report. It's only material for you to include it. Example, failure to company to deposit fraudulent fund dues, default in repayment of loans or borrowings of institutions. This is a very important. You need to be very careful because when you're applying it, it should not impact your impairment of your subsidiary or investments, that you should be very, very mindful of. So you need to be very careful when you're looking at these aspects of it when you're reporting on CARO. Now, so what are the key considerations for the auditors? So one of the key considerations is in where the sanction is made against security of assets, make sure the submission of quarterly submission is on a timely basis to the bankers. Make sure verification of completeness and accuracy of information furnished in the quarterly are reconciled. This is a very important aspect even from a control perspective. If there are any loans or guarantee in the nature of it been fallen due during the year, as it been renewed or extended, look at from this aspect of it. You have to evaluate all loans to subsidiaries and to make sure, or any other entities to make sure there are no rollovers. It's a very important aspect of it. In respect of term loans, make sure these are being utilized. I'm just doing only a rehearsal to make sure that you have an understanding as to what we have discussed so far. Funds utilized on short-term basis, make sure you look at the complete cash flows, whether they've been utilized for the long-term purposes. taken for funds and to meet any other obligations, make sure the monitoring of application of funds are looked at it. Look at the covenants given by the bank. Whether the auditors consider whistleblower mechanism, look at whether they have any anonymous calls, hotlines, and all of that, or if they have an independent mail ID which can be looked at it. Ratios are very, very critical. Look at it whether it has got any impact. I will pause here, Vivek. If there are any questions relating to CARO, I will take care. Otherwise, I will take through the amendments to Schedule 3. Vivek? Vivek, if there are any questions.
Yes, sir. Yes, sir. Yes, sir. We can take the questions once again. I'll just enable the chat. In the meantime, sir, there's one question which is there with people. That is, if a company has taken LC, so whether LC will be called as borrowing or non-fund based limit if a company has taken, whether it will be called as borrowing. Because company has issued the LC to a person and he received, the person has received the money and company sells that product at advance. So in the clause where the money is received from any source, whether this will fall.
Sorry, I just missed your.
The question is whether amount, whether LC issued by the company, by the bank on behalf of the company will be called as borrowing.
So the question is, LC is only letter of credit unless that letter of credit is linked to a loan, right? Which is both fund-based and non-fund based, because the borrowings that have been defined is fund-based and non-fund based. Any fund-based and non-fund based is the basis on which you would consider as the borrowing. So it includes both, because LC generally falls under that category.
Thanks a lot, sir. Mr. Gaurav Modi, you had a question that raised your hand. You can unmute yourself and ask your question. Gaurav?
Very good evening, sir. Sir,
Continue, Gaurav. Be a bit louder.
Hello, very good evening, sir. I have a question, like, sir, as you explained that any amount that has been any company which takes loan to fund its subsidiary, whether if that loan has been taken in earlier years, whether that also needs to be reported or only during the year loans needs to be reported.
So when we talk about loans, we are talking about loans utilization. We have to also talk about loans repayment, right? So if their loans are taken and it is utilized, that is one aspect of it. If the loans are taken and repaid, that's another aspect. The transaction should be reflected and you should include both of them. In the earlier slides that I've explained, that where loans are taken and used during the year, whether it relates to current year or in the previous years, whether you've availed and utilized during the period, you have to report.
Thank you, sir.
So there's a question that we have to see the title deeds of immovable property. It says title deeds of immovable property in inventory, investment or others. So whether title deeds of the immovable property which is lying in my inventory will also be required to be seen for a real estate person who is dealing in real estate.
So, so if you have got a title deeds, and basically the title deeds are predominantly relating to immovable properties, right? Now the question is, why is this needed? And especially this fixed asset, the moment you call it a fixed asset, right? The title deed of that immovable property is what is being focused on, right? Because on which you are taking a borrowing or there's a charge which is created on those assets. And that is the reason why you need to report only on those immovable properties. And that is why it is very critical.
Thank you, sir. Sir, there's one more question from Mr. Mahesh Kumar Madan. Sir, profit-making company gives loan out of cash credit, whether it amounts to diversion of fund.
So, profit-making company gives loan out of cash credit. No. So let's put it this way. What is a diversion of a fund? Diversion means I have an arrangement with a bank. So what is the arrangement with the bank? Let me give you an example arrangement with the bank. The bank says, you went to and approached a bank and said, listen, I'm planning to expand the business. So therefore, for construction of this asset, building, and purchase of machinery, I need X amount. It's a profit-making company. The eligibility comes to the company because it's a profit-making company, basis on which the bank sanctions the amount. Once the bank sanctions the amount, now you've taken this money and instead of putting it into buildings or purchasing assets, you've given it as a loan. Is that a diversion? The answer is yes. So that it is nothing to do with profit or loss of the company. It is to do with for what intent you have borrowed the funds, and that is what matters most.
Thank you, sir. Mr. Mahesh, you have a question. You can ask directly to sir. Kindly unmute yourself.
So there was something on non-cash. Non-cash is nothing but if I'm doing a settlement of a fixed property assets or a security with anyone without the use of cash, it's called a non-cash transactions. I may give a fixed assets and issue a shares against it. That's called a non-cash transaction.
Thanks. Yeah, Mahesh, you can go forward.
Yeah, so my question is regarding the reporting in CARO about working capital of 5 crore and above based on current assets. For NBFC Division 3 doesn't ask for the bifurcation of current and non-current. So when we are reporting for it, what basis should we take? Because ideally that reporting will not be in sync with the financial statement because it doesn't show that bifurcation at all.
No, I do understand. For NBFC, you have a separate reporting, but the fact of the matter is that, you see, NBFC also, it takes loan and lends loan. Let's say it's in the business of the loan.
Yeah.
Now, specific matters, whatever is required under the RBI, you need to include that. The specific disclosure under the Reserve Bank of India. Because what is the purpose of an NBFC? NBFC is taking loans and giving loans. And therefore, whatever is the RBI guidelines for NBFCs, you will have to give that. The bifurcations.
Okay.
Okay. So I will take to the, yeah. So I will go ahead with the amendments to Schedule 3.
Yes, sir.
All right. So amendments to Schedule 3, and why I said this is important is if you have gone through the entire CARO process, where the CARO will provide you information relating to what is the responsibility of the auditor. Now let's look at what is the responsibility of the management. Now this is where you need to focus your attention. Now again, this is applicable effective 1st of April 2021. It's applicable, again, it's been classified into Division 1, Division 2, and Division 3. Division 1 are those companies which are complying with accounting standards. Division 2 are those companies following Ind AS, and Division 3 specifically relating to NBFCs. The whole objective is to align the amendments, is to align with the CARO reporting 2020. Now let's look at the summary of amendments and which are the ones which are on red, which have got significant impact, and which are the ones which are general and which are on the amber rules. Now, if you look at the summary of amendments, right? Aging for trade receivables along with categorization between disputed, undisputed, and good and doubtful. Now you have got specific information to be provided both for the disputed, undisputed, as well as impaired assets. Similarly, for trade payables, also you need to provide information relating to capital work in progress and intangible assets under development. Aging. Aging is 0 to 30, 30 to 60, 60 to 90, 90 to 180, 180 and above. Whichever categorization you're doing it, you have to provide. Title deeds of immovable property not held in the name of the notes of the company. Again, we have covered it as a part of CARO. Now it is to be included as part of even the notes to accounts. And disclosure whether the fair valuation of PP we have talked about, it has to be included in notes. Changes due to revaluation of property, plant and equipment, you need to include as part of the notes. Shareholding of promoters in share capital note. Now this is the expansion that has come through with the shareholding of promoters. Earlier, there is to be categorization of any shareholding over 5% to be reported. Now the entire shareholding of promoters has to be given in the notes to accounts. Loans or advances to promoters, key managerial persons or related parties in the nature of loans, either repayable on demand or having no terms or period of repayment and proportion. Current maturities of long-term borrowings to be disclosed as short-term borrowings. Earlier, it was coming under current liabilities. Now you have to say under short-term borrowings because there's a classification that has been brought in. Security deposits to be disclosed under other financial assets. Leased liabilities to be disclosed under current and non-current financial state. Liabilities in the face of balance sheet. Undisclosed income for transaction not recorded in the books but surrendered has to be provided. Details of corporate social response included. Disclosure for equity to be given for prior period also. Separate column has to be given for defined benefit plans and financial liabilities in the reserves and surplus. Details of quarterly returns and summary of reconciliation if borrowing is against security of funds. Details of utilization of borrowed funds and share premium, including diversion of funds and utilization with the funding property. Details of Benami properties held. Details of default if companies declared willful defaulter by bank or financial institutions. Delay in registration of charges of satisfaction beyond statutory period. Details of where the funds are utilized if the utilization of borrowed funds is not for specific purposes. Details of cryptocurrency or virtual currency. Disclosure of ratios along with explanations of computation details in excess of 25%. Disclosure of compliance with approved scheme of lay arrangement and deviation thereof. Compliance with the number of layers under the companies if not more than 2. Relationship with the stuck-off company. This is a very important aspect of it. Whenever you look at the relationship with the stuck-off companies, so far this information was never asked for. If there are any companies which have been struck off under the ROC, which has happened, in fact, the government has struck off more than 2 lakh companies in the last 5 years. And if those are struck off companies, if there are any transactions with those struck off companies, these needs to be included as part of the disclosure. Now, whilst you might feel, while some might feel that, there is so many things which may not be applicable to us or may not be applicable to many of you companies which you're auditing. But if you've got transactions which has an impact and with the company's name figure out, these are something which needs to be disclosed. So let's look at it in more detail as in the financial statements. Now, for the first and the foremost is you need to identify trade receivables and classify it between current and non-current. That's number one. When you disclose this trade receivables, you need to disclose between secured considered good, unsecured considered good, and doubtful. This was the original requirement under Schedule 3. Now, with aging that has been required, now what are the things that we have now bringing about? We are bringing about undisputed trade receivables considered good. Undisputed trade receivables which have significant increase in credit risk. Undisputed trade receivables where the credit is impaired. That means where it is doubtful. Disputed trade receivables which are considered good. Disputed trade receivables where significant increase in credit risk. Disputed trade receivables where credit is impaired. So let me explain to you what it means. So you have a transaction when you enter into a transaction with a customer. So the company enters into a transaction with the customer. At the time of entering the transaction, the company's customer was very good. So for instance, during this COVID period, you had entered into transactions. Prior to COVID period, you entered into transactions that you were getting monies in a regular basis. Now, because of the COVID period, it had an impact, your customer had an impact in his own business. And therefore, there is an increase in credit risk. That means originally he was paying all my 100%. Now you believe that he may not pay me 100%, he may pay me about 60% or 70%. That is what is called, which have significant increase in credit risk. Where this customer was there, he was out of business. You're doing the business, he suddenly is out of business. Then it becomes where credit is impaired. Now look at this. For instance, the Ford is out of India, right? So you are having transaction with Ford company. Suddenly the Ford is said is switching, he shut down his office and gone. And these were never disputed. He shut down his office and gone. Now question is it credit impaired or significant increase in credit risk? I think that is what you need to evaluate. This is very simple as far as undisputed. But even in disputed trade receivables, what do? You have a dispute with a customer, you file a legal case. and you are very confident of receiving. That is called disputed trade receivables considered good. Then disputed trade receivables, you say you will get it, but you're not getting it, especially when you have got transactions with government companies. You've got transactions, let's say you're doing in a reality sector, there are transactions with them. If there are transactions which relates to them, and you believe that there is every likelihood that these receivables will not come back to you, that's called significant interest. The other disputed is where completely the customer has disputed and has also gone bankrupt. That becomes credit impaired. So now you need to classify it less than 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. And all of these information, which generally you carry out as a part of your testing, is now coming as part of it. What are the things it will impact? It will impact technology, it will impact process, it impacts other members of the team. So from a perspective, from a company's perspective, from a risk control perspective, you need to consider all of these as part of the process. Similarly, for trade receivables, for trade payables, now you need to classify between trade payables due to micro, small, medium enterprises and other than micro, small, medium enterprises. This was already the original one. But now you need to classify between MSC, others, again disputed is with MSC and disputed with others. Give a classification between less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. We used to always give a comment saying that this information was readily not available, and therefore you are not provided information to MSME. Now you need to have all of this information captured as a part of the AG. And you need to also make a distinction between whether the transaction with that MSME or transaction with others were disputed or not disputed. If it is disputed, bucket it twice between less than 1 year, 1 to 2 years, 2 to 3 years, and above. Similarly, for capital work in progress. Now, this is a very important point which has been introduced both for capital work in progress and intangibles. Many companies went on recording all of the transactions into capital work in progress. And one of the points that was raised by the banks saying that, listen, we have been funding these companies, but they always say capital work in progress, what needs to be done? So when this was addressed, then they said, listen, let's have an understanding about what are the capital work in progress and what is the age of these work in progress. And when was this originally estimated to be completed, and when it is getting completed, and what is the reasons for completion? Look at all of these. Capital work in progress means project when commissioned. What was the original date of commissioning and when it is commissioned? When was the original date of completion and what is actual commission? And the reasons why there has been delays. And you need to give both project in progress and project temporarily suspended. Less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. Both for CWIP and intangibles under development. This is one change which will bring in, because all of this capital work in progress so far, which does not have aging classification. You never used to have anything on relating to fixed assets. Now this is a part of the disclosures that are required. Now we talked about the title deeds of the immovable properties, excluding the lease assets not held in the name. You have to give the name item, description of the item, gross value of the property, title deed held in the name of whom, whether title deed holder is a promoter, director, or a relative, property held since which date, reasons for not holding it in the name. And this used to always happen because whenever a funding is required by the promoter, they used to transfer the land and buildings, but not legally transfer this information as part of it. And that is the reason why, again, as I said, this Schedule 3 and the CARO disclosures are more driven from regulators, from ROCs, and from bankers. Wherever the title deed is not held, you need to provide that information. Next. A reconciliation of gross value of assets and net carrying of assets, including the disposals, have to be provided for. Now, what does it say? If there is any change more than 10% due to revaluation, that more than 10% information has to be provided, whether he was a competent, whether the fair valuation was carried out by a registered valuer, whether he was competent, whether it was because of the first time adoption of Ind AS or there was any reason for any remeasurement. All of these have to be disclosed as a part of balance sheet. Now, the next change that came up in balance sheet was the shareholding of more than 5%. From a shareholding of holding from more than 5%, now the amendment talks about all promoters to be included and the number of shares and percentage of shares. It has to be provided with promoter's name, number of shares, percentage of shares, and percentage during the year. Additional details requiring to promoters holding and movement during this shall also be disclosed in the equity share movement. You need to examine all of these secretarial records when you're examining. Next, the next requirement change came in the amendments to Schedule 3, where the company makes any loans and advances to promoters, directors, KMP, you need to provide disclosures relating to this. Type of borrower, amount of loans or advances in the nature of loan outstanding, percentage to the total loans advancing in the nature of loans. You have to give promoter, director, key managerial person related parties. So the above table would need to be disclosed in notes to accounts. Further, CARO also requires you to report on loans to promoters. Considering their intercompanies or disclosure also would be required to be prepared manually. So all of these you need to include as part of Schedule 3. What are the other amendments that came through for more from a logical presentation? Current maturities of non-current borrowings, they just moved it from current maturity of long-term borrowings to defining as short-term borrowings. Other disclosure to financial is included security deposits, bank deposits for more than 12 months of maturity, others, all of these to be shown under other financial assets. Lease liabilities should now be shown on the face of the balance sheet. Many, if you are a part of Ind AS, already would have been shown immediately. What are the changes in the profit and loss account? There have been also been changes in profit and loss account. If there are any transactions which have been recorded for the first time, you need to provide information relating to all of these based on the income tax assessments. If there are CSR items, you need to give the amount of spent by the company during the year, amount of expenditure incurred, shortfall at the end of the year, total of the previous year shortfall, all of these should be included as part of CSR. In the changes in equity, again, this is more driven from if you are reporting under the Ind AS. The original item of requirement was to provide only the equity capital balance beginning and changes during and closing. Now you need to provide the statement of changes between changes of equity due to prior year errors, restated balance at the beginning of the current year period. Now this is in case if there are any restatement happening because of a prior year, because earlier what used to happen, if there were prior period errors, you never had a situation where you could go and restate the financial statements. Today, if there are any prior period errors, for instance, the depreciation was incorrectly calculated or inventories was incorrectly calculated, right? You can go and rechange the previous years, but you should call it as restated balance sheet at the beginning of the period. You need to provide the changes in equity due to prior errors. All of this should be incorporated as part of disclosures. What are the other disclosures that have come? If the bank company has taken any loans of financial institutions, whether the corporate guarantees, whether the quarterly returns have been, or statements of current assets which have been filed with the banks of finance are in agreement with the books of accounts. If there are any differences because of the reconciliations, those needs to be disclosed. Similarly, the utilization of borrowed funds and share premium needs to be included as a part of the disclosures. These are very, very important disclosures. Other important aspect of the Benami transaction we have touched upon. Details of default, if the companies declared them as a willful defaulter, we already spoken in the CARO part of it, but these are the information which should also come in the notes to accounts. Similarly, registration of charges. Disclosure of charges are satisfactory yet to be registered with the register of companies beyond statutory audit period, to be given with details and reasons. Utilization of borrowed funds, where the company has not used the borrowings from banks and financial for specific which is taken, those information should be provided. Cryptocurrency or virtual currency may not be applicable in India, may be applicable for those companies which have got transactions outside of India. Those needs to be provided. Now, what are the ratios to be provided? This is a very important aspect of the amendment that you need to look at it. The ratios that have to be included are the current ratio, debt equity ratio, debt service coverage ratio, return on equity ratio, inventory turnover ratio, trade receivables turnover ratio, trade payables, net capital turnover ratio, net profit ratio, and all of these. All of these are got basically nothing but these are called the solvency ratios, which has an impact whether the finance company is in a position to pay all of its financial liabilities. If there are any differences more than 25% between the previous period and the current period, you need to make the disclosures, and these are forming part of the revised Schedule 3. If there are schemes of arrangement, again, these are schemes of arrangement through amalgamation mergers, whether these have been carried out in accordance with the accounting standards also need to be provided. The other aspects of it is you should not have more than 2 layers of investment companies. This is, so therefore, this is again is to be in compliance with Section 2 of Clause 87 of the Companies Act. Now, this is an aspect which has been introduced in the current period. What is this aspect? Suppose if there is if any of your companies had entered into a transaction with those companies which have been struck off under Section 248 of the Companies Act, then whatever transaction this company has entered with those companies. So how will you find out? You have to go back to the MCA website and download from there the list of companies which have been struck off. Take that, and if you see if there are any transactions which have not moved for more than 3 years or 4 years, to see whether it's in investment securities, receivables, payables, shares, all of these need to be provided as a part of the disclosures. And this is a very important app. The MCA website has got a comprehensive list of those companies that have been struck off. So there is a change that has come in the auditor's report, and the auditor's report is a very important aspect of it because 2 specific amendments which are very important relating to loans. One was the earlier we had a specified bank account basically based on demonetization which went off. Then transaction relating to funds advance is a new reporting that has come through. Then the audit trail is something which is going up into 1st of April 2022. But compliance relating to declaration and payment of dividend, clauses under Rule 11E and 11F are a very critical, important aspect. Just remember, as much as CARO, where you're giving opinion based on evidence, collecting of evidence, as much as information that you're including it as a part of the balance sheet, here is a responsibility where you're specifically commenting on transactions related to funds advanced or received by entities. This you need to be very mindful when you're looking at whether if it is of borrowed loans, advances, or investments, whether to any person, including foreign entities, including these ultimate beneficiaries, directly or indirectly, all of these fund-related transactions have to be considered. You have to get the entire details and comment upon it. What is that you need to comment as in the auditor's report? Whether the management has represented to the best of its knowledge belief, and that other than those disclosed in notes to accounts, no funds have been advanced or loaned or invested either from borrowed or share cap premium or any other source of funds by the company to any person, entities, including foreign intermediaries, with understanding, whether recorded in writing or otherwise, that the intermediary directly or indirectly lend or invest or entities on behalf of the ultimate beneficiaries. That means you cannot be involved in any, the company cannot be involved in any transactions that has a far-reaching impact of the ultimate beneficiaries. There's ultimate beneficiaries are defined under Section 8990 of the Companies Act. Whether the company is represented to the best of its knowledge, no funds have been received by company. It's not only giving, but also no person's monies have been received, including foreign entities, with an understanding whether recorded in writing or not, directly lend or invest in persons identified in any manner on behalf of the funding partner. So that means you have to be very mindful of identifying who are these ultimate beneficiaries, and this becomes a very important aspect of it. Whether dividends declared or paid during their in compliance, this is something which the clarification has been issued by AASP. All right, so what are the key takeaways from these changes that have come through in the Companies Act. One of the key changes that have come through in the Companies Act as well as in the CARO, both CARO as well as Companies Act are now in sync with the amount of information and disclosure that has to be provided. To equally as much as the responsibility for the audit management has gone up, the auditor's responsibility have doubled up over a period in time, including doing away from information and explanation obtained to examining of these evidences. And examination of these evidences are very, very critical when you're reporting each of these clauses. It is not only about seeking this information from asking the information on management, but also you should seek the representation letters in respect of specific items relating to all of this, especially on related party transactions, on borrowed fund, dealings with the ultimate beneficiaries, investments, making sure that whatever funds that you've borrowed from banks and financials have been utilized for purpose for which has been it. There are a host of things where the honest responsibility is on the auditors. And therefore, it is critical for all of us as professionals that we look at this CARO more closely, address it point by point, clause by clause, and therefore only then when we have the sufficient information. Otherwise, please do a modification in your CARO report as well as in the audit report, including that of internal control over financial reporting. That's all I have from my side. I'm more than happy to take questions. Vivek, if you've got any questions on this, if you have additional questions, then we can take it up from you.
Sure, sir. I'll just take the questions. Whether disputed dues, either trade receivable or payable, should be taken where court cases are going on or otherwise?
Which ones? Whether disputed is either trade receivable or payable should be taken where court. Absolutely. The moment if it is a disputed, it should be falling under trade receivables disputed. And again, even in the disputed, you need to further go and analyze whether the disputed dues are good, whether the credit is a likelihood of impairing of a credit risk or the completely credit impaired. So you need to again look at each of this, examine it and report it.
Thank you, sir. There's a question again. Can you please explain unbilled trade payables?
Okay. The unbilled trade payables is nothing but what happens is you bought the goods. The goods comes into your factory. It comes as a part of an inventory, but this purchase invoices have not been received by you. So this becomes an unbilled trades payable. So therefore, for all of this becomes goods received for which invoice is not received. It's called GR/IN, goods received but invoice not received. So for all of that, you need to set it up, even included as part of the payables. And this is what is unbilled trades payable.
Thank you, sir. There's no other question in chat box. Anyone having any question, they can raise your hand. In the meantime, sir, a small query which you have also deliberated. A defunct company, disputed company, how do we check as an auditor? Transaction with the defunct company, disputed company, how do we check as an auditor? Because when we go to MCA website, it is in the PDF form, and in each state there are 21 to 40 files. It's very difficult. What we have thought to ask the client first to take a non-moving customers or non-moving data, 2 years, 3 years old, first check those, then we'll think of anything apart from that, if you have any other view.
No, so the point which is there is, I do understand it is state-wise all of this, but what you should do is this. You need to look at, see, one is a component there, but I know it's about the 2 lakh companies which are there. From the companies list itself, look at which are the transactions that you happened with those companies have actually not moved for long. Right? That's the first step. Right? Then what you do is go to the search of MCA and put that name. It will come. So you can, so there, it's a one time. I agree with you that this is something which, but the problem what has happened is the onus is now both on the company as well as in the auditor. Okay. The only way, if you have a secretarial auditor, if there is a secretarial auditor, ask the secretarial auditor to confirm which are the companies which are. That's the best way to get away from this.
Yeah, that's a good one. We can take a certificate from the secretarial auditor also.
You say, please confirm to me whether these people are there as part of this thing, and they get the confirmation.
But really, this is really tricky, and like most of our clients get their balance sheet signed in April and May. It is next to Herculean task to get it done. Next to Herculean task.
No, I'm with you on this, but you see what has happened is, they're coming in reverse way. आप लोग जब बैंक ऑडिट करते हो 2-3 दिन में कैसा काम खत्म करते हो? If you are talking about company, you say April में मैं खत्म, but bank audit guy will come up 1 week before, sir, आप 2 दिन में खत्म कर दीजिए, sir.
Sir, I am doing it right now as journal auditor, as a central auditor. All the bankers are listening to this also, but we are getting it done.
I'm just giving you. No, I'm just giving a simple example. I just give.
No, that's true. See, that is true, and we have to race against time, and we have to be street smart to get the work done with proper documentation. At least that's what we have done.
No, I would say documentation is a second. So let me tell you one thing. Today documentation under SA 230 is only support for what work we have done. Unfortunately, our documentation is tick in the box. Checklist fill up karo, we have verified this. The point is, have you verified transaction? Is who's going to give you that? I'm more focused in verification of a transaction rather than document. At least verification of documentation becomes part of your supporting document.
That is the TOD which we are talking about. The TOD should be there for the sample size, whichever we have selected, but TOD should be there.
Exactly. Entire TOD should be there. It's not only the TOD. TOD is more driven from a substantial. I'm saying you do an analytical review, because today, see, let me tell you one thing. All of your banks, and you are doing bank audits, right? I'll give you, there was one instance, one of the chartered accountant called me up and said, I have a peculiar situation. The peculiar situation is, they have the whole bank, the branch has about 75 crores, of which 25 crores was to one entity. The 25 crores was split into 5. These are all partnership firms. And there was one default during the COVID period. Okay. There are 2 sets of balance sheets that have been given by the so-called the company. I'm sorry, the borrower. Now the banker auditor is asking me, what should I do with that? Partnership firm, you can't even find out information from this. Okay. 2 years onwards, they have not submitted balance sheets. 2 years, they have not submitted income tax return. Now you tell me.
So similarly, when we are seeing the current asset details given to bank for the working capital loan, so some people have this question in their mind whether we have to see current asset only, or whether current liabilities are being deducted or not. The full DP has to be checked. I think the question is
complete. There is, sir, मैं खाली एक ही sides दो. I will only see where I get money. I don't see where there are payments.
Because the basic essence of the provision is that the bank has been reported the net current asset or DP.
Absolutely.
Because there will be some gaps which we'll find in many companies, and this has to be checked for both the years, comparative also.
No, both the years. In fact, it's for both the years. It's very important. See, but for at least for a working capital के लिए 1 साल के लिए बस है. But I'm talking about aging जहाँ पे भी है. See, for instance, if you take capital WIP, you don't need to give an aging of because earlier period, because the current year में सब कुछ आ जाता है. Okay, उसको previous year का भी आ जाता है. But consolidation में जरूरत नहीं है, because that's something which is a part of it. But I'm just saying, aging for receivables, payables, all of this has to come with throughout the periods, because parties change, parties would change.
And the best part will be when we are giving aging, say from next year also, and we have to justify that why there has been written off or written back, and the income tax department will start up with the balance sheet and ask me to explain why you have written off, written back this big amounts of debtors and creditors. Right now it is netted off and going in a single account.
Absolutely, I'm with you on this. I'm telling you, these are some things we have to be very careful. See, there are 2 ways I'm saying. As an auditor, be mindful as to how they're presenting it. And I'm saying, बोलते ना दामाद के जो दिन थे सब खत्म हो गए. Okay. अभी बुजुर्ग कैसा ऑडिटर कैसा करना चाहिए. The story is gone away. The story of your what do you call as the royal treatment for an audit, so-called the auditor, is gone.
Right? जीवन खत्म हो गया, मरद जीवन चालू हो गया.
Yes. So better report on those things, because there's a only simple way to do it. What protects you is your report. What protects your verification. What protects you is your document.
And so now if there is a deviation in the stock statement shared with the bank or the DP shared with the bank along with the books of accounts, because when we say stock also, we have to understand that in the stock also we have to see that this stock is as per books of accounts, and when we say as per books of accounts, then valuation as per AS2 or Ind AS 2, correct? And monthly valuation is not done in most of the companies, they do yearly valuation only. So the actual valuation which they are sharing, it's whether cost or NRV, whichever is lower, or what is the value, what are the things they are capturing in the valuation, all this becomes a big challenge. And people are not ready to accept that we have to give this.
You have to provide this. This again, I'm only saying is more and more we are exposing ourselves, more and more we are exposing with more and more the MCA coming through and saying that, you know, everybody is the same. I think they don't make a distinction. See, this is where the irony of it. They're not making a distinction within a firm which does not have so many people versus a firm which has more people. You have to have small, medium firms as a separate treatment, larger firms as separate treatment. Only then it is possible. Making say that everybody should do the same, I think is becoming the biggest challenge. Because somewhere, you know, that's where I believe, because if you see the recent one, the report that has been issued by the Corporate Laws Committee, I think that direction is like saying that agar mere paas company nahi, 11, who are the people who have not reported? 11,000. Who are these people? One partner, two partner firms. They don't even have a laptop or they are doing whatever information. Now, if they have not provided, you are saying a NEFRA should be given the authority to penalize them. I mean, the point where are we going to? If our objective is to regulate the profession, then there is no end to it.
That's true, sir. That's true. And there is actual difficulty also because in CARO, although we have to give report for working capital limit taken more than 5 crores, but for companies under Schedule 3, everything has to be reported. There is no bifurcation. So we talk about like for IFRS for SME and IFRS for all. Over here, we require in the near future Schedule 3 for SME and Schedule 3 for big companies, large companies. Correct. Because this going concern 11 ratios for a small company having say turnover of 50 lakh, 20 lakh also, most of the ratios will be null and void.
I'm just simple saying, that's why I'm saying, somewhere you're saying they don't have solvency. Somewhere you're not reporting going concern issue. That's the biggest challenge that we will be facing. That's why I said, please link everything together.
Correct, connecting the dots.
Yeah, connect the dots.
And secondly, for the deviation more than 25%, they have to give a justification. Company will say justification is COVID-19.
Correct.
Justification for drop in the turnover, drop in the profit. It's COVID-19. But for what justification they will give for the DP given to the bank where they have not deducted creditors, where they have not used the advance taken from customers. So all this, what justification they will give? And if they give a justification, this was given mistakenly every month, whether this will be a fraud and whether this fraud reporting has to be done.
So I gave you a very thin line of, there's a very thin line of difference of what fraud is. So I give you an example. The example of a fraud I gave you was that, let's say you are commercially dealing with a company where its transaction is 80% the check and 20% is through cash. Now what is the 20%? You've actually violated the law under the GST by not having, making the 20% go through the GST invoicing. So that also should come. If fraud is intent by the company, by the employee, by the officer, with an intention to defraud the other person, that means the purpose for which it is created is not done. So therefore, even that would come. So it's a very critical aspect one has to examine. Now let's take the case of banks, NPA. Because you're saying you're all doing bank. Let me give an example of a bank. So now you have identified, it has to go to MOC. You have identified so many things. This guy has done a rollover. Now the banker comes and says, "Sir, आपको मैं वो client के पास ले जाऊँगा, sir. आपको client से बात कराऊँगा, sir. Client तो आपको assure करेगा, sir. ये देखो ये check." He will tell you why he has not been a position deposit check, because he's got an ailing mother, he has got an ailing father, he has got an ailing someone. Because देखो sir, government तो आजकल sir आपको ना sir bureaucracy करना आज कल आ जाएगी sir, आपको क्या हो जाएगा? आप जिस दिन साइन करोगे ना उसके बाद तो भूल ही गया, 1 साल तो हो ही गया. The point which I'm trying to say is, we always go with a trust. Unfortunately, we are auditors. Trust, but verify. If you're not convinced of verification, don't accept on over. And
That is,
you are not an auditor of the borrower. You're an auditor of a bank. Why should a borrower be called to talk about it?
not only that, sir, we are doing zonal audits right now, and we have found many accounts say having I would say, having a borrowing of say 5 crore, and total debits and credit during the year is 10 lakh. So
4 lakh, 5 lakh,
10 lakh. So I asked boss, 10 lakh ke dhanda kiya CC, they are not routing the transaction to CC. And if they don't do through the CC, this account has to be reported as fraud.
Right.
So, and the list goes so big that we have to have another meeting for that. So these are the issues. I truly agree. And the hard point is that we as a auditors, I keep on saying one thing. Earlier, we used to have a direct tax practitioner, we had GST practitioner, and people used to take audit ki audit karenge to baki kaam mil jayega. Now it is more about a specialized job. You have to be assurance expert. You cannot say I am doing audit just to maintain the client. You have to do audit to justify the audit which we are doing.
Correct.
And documentation also, if you are not doing, we keep on saying audit not documented is audit not done. If you're not able to prove in the court of law that you have done watching, you have not done watching. You have to have a document to prove you have done watching, whether TOD, TOC, whatever format you have, AR, whatever format is there, you have to prove that. So all these things are actually important, and with coming of the NEFRA and the new bill which has been passed, I think it's right time to open our eyes, either leave the profession of the assurance or become the expert of assurance. It cannot be between the two. And therefore, Section 144 and this NEFRA ruling and all are coming.
So my question is, I fully agree with you. The point is, just because a patient would get killed, the doctor does not go away. Just because a borrower will become defaulted, the bank will not stop them. Just because there will be accidents on the road, the person who is driving the car will not. So the question is not about what, it's doing the right thing. And when you believe that this is the manner in which it's done, I think as far as possible, that's what I'm saying. If we do what is to be done, today we will not have the issues. But there are certain things which are beyond you. There are certain things which you can't do. But the point is, if majority of them gets covered, I think we should be good. But as I said, it's all evolving. So there will be more litigations. The more NEFRA comes, the more litigations. The more litigations, the more court. See, there is one profession which has always survives, the law, legal profession. So chartered account karo or legal profession karo.
So it means, yeah, it means that with CA we have to do a law also and come expertise.
No, you need to. That's why, because we have got multidisciplinary firms, no? MDF.
So वो तो सपना है, वो तो सपना है, कब आएगा मालूम नहीं.
Because
anyhow, thanks a lot for your session today, sir. And this is a virtual memento which we are presenting. We hope this finds a place. We'll send you over mail. You can print and laminate it. We all are learning the COVID way. And friends, we are happy to inform that on 30th, we are organizing ACA CFO Leadership Conclave. And we request everyone to attend. We have CFO from various companies like Zydus Cadila. We have CFO from Compton Graves. We have CFO from Rallies India and Senior Vice President, ex-CFO of Tata Power. The program being moderated by our very own President of ACAE, ex-President of ACAE, Mr. P.R. Ramesh. And we all look forward for you to attend that. Secondly, we are thankful to Ganesh sir, and I would request Gaurav Moji to give a formal vote of thanks to Ramesh sir. Gaurav, are you there? I think Gaurav is not there because he is also a bit tied up with audits and all. So thanks a lot, Ganesh sir, for coming at ACA at a short notice from a busy schedule, because we all are fighting with the board meetings and all. And we look forward for more sessions from you, Ganesh sir, and hopefully to have you physically next time at ACA. Thanks a lot. Thanks a lot, Ganesh sir. And thank you everyone for attending this in between your audits. I know branch audits are over for most, and we all are preparing for audits. And some people are saying it's too early to have a session on CARO and Schedule 3 because audits will come in September or August. But we should be ready, because it is time we should educate our clients. Because if we don't educate our clients, what they will give is a dump, and garbage in will be garbage out. So if we educate our clients at the right moment, they'll have a right details, and we'll be giving a better reporting and true and fair view by the balance sheet which we prepare. So looking forward for more session with Ganesh sir, and thank you everyone for joining. And you can get this session on YouTube as well if you have missed any part. Thanks once again, Ganesh, and thank you everyone for joining. Ending the meeting.